I'm Bill Purcell, COO of Off the Chain Capital, and I want to introduce our managing partner and CIO, Brian Estes. He's going to do the presentation today. It'll be about 45 minutes, and then we'll follow up with questions. So we want to run through the material. Then if anyone needs to leave, we can be respectful of time, and then we'll hang around for an hour or so afterwards if there's any questions. A little bit about Brian's background. Went to U of I. He had a scholarship to play basketball at U of I. Brian was in a car accident at 16 and went to U of I, studied economics, studied abroad at Cambridge. At Cambridge, he learned a lot about technology adoption, S-curve analysis, learned about bubbles, and it helped lay the foundation for what we're doing today in Off the Chain. Brian and I met here at WashU in these rooms. We had 2 years we spent together. We were on a team together, and I would say a sponge for Brian's knowledge. He has implemented a strategy that's worked over and over. Prior to Off the Chain, Brian started his career at AG Edwards. He was an institutional broker. Spent 14 years there. His clients were Vanguard, Reinsurance Group of America, Bank of American Trust, if you remember Boatman's. That's one of his clients. In 2004, he left AG Edwards, started his own firm, Estes Financial, managed about $350 million for a handful of institutions and endowments. In 2014, Brian learned about blockchain and Bitcoin and sold his practice and has done a deep dive in the space. He's made many investments and, like top names in the industry. If you've heard of Coinbase, Digital Currency Group, Bitcoin, early investor in all those, and mentored and helped start two famous companies, Polychain and Block, which now have a market cap of around $10 billion. So without further ado, here's Brian.
Thank you guys for coming in today. So like Bill said, I might try to zip through these slides relatively fast, take probably 35, 40 minutes to get through them, and then we'll open it up for Q&A right after that. So before we get going on this, blockchain assets are very different from traditional assets like stocks and bonds and real estate. So I always throw this slide up because we have to think differently about these things. You can't use PE ratios or price to sales or cash flow analysis with blockchain investments because they're networks, and you value networks in a different way. And so before we start, I just want you to kind of clear your mind of the old ways of looking at things, and let's for the next 45 minutes, let's think about the new way of valuing networks and blockchain assets. My journey with Bitcoin and blockchain started back in 2013. I saw these guys on CNBC. These are it's Cameron and Tyler Winklevoss. They're semi-famous for having come up with the idea of Facebook that Mark Zuckerberg stole from them at Harvard, and he started Facebook with their idea. Cameron and Tyler settled that they had a lawsuit with Zuckerberg, and they received about $60 million from Facebook in settlement. They took a large part of that money and put it in Bitcoin back in 2012, when Bitcoin was about $10. And so they own 1% of the world's Bitcoin today. And when I saw them on CNBC in 2013, I didn't know anything about Bitcoin or cryptocurrency or the Winklevoss twins, and I saw that they owned 1% of the world's Bitcoin. It was around $100 at the time when I first saw them, and I thought for sure they're doing a pump and dump scheme. They're trying to go on CNBC, pump up the price, dump it, sell it, and and then when I looked into Bitcoin, I saw it was used for nefarious activities, drug deals, murder, all sorts of bad things, and I was like, who would ever want to touch this? So I kind of watched it for the next year, and I watched it go from $100 up to $1,200, and then it crashed down to about $300 or $400, and that's when I got interested in it. And so during this 15-month period, Bitcoin went from about $10 to $1,200, so it went up 12,000% in about 15 months. And that was that bubble that I saw right there. And then since then, it's had a series of bubbles after that, where it got up to $20,000 a few years ago. One thing to know about Bitcoin and cryptocurrencies is that They're very volatile because they're misunderstood. People don't understand how to value them. They get excited on the upside when they go up and they buy them too high, and when they go down, people panic and they sell them. So a good stat to know is that since 2010, Bitcoin's dropped 70% or more 4 times. So you ask yourself, why would you want to put a very volatile asset that is risky in your portfolio? And so that's what we're going to talk about today. So when I was at University of Illinois, Mark Andreessen was 2 years younger than me. He developed a piece of software called Mosaic. When he graduated from U of I, he used that software to start Netscape Navigator, which was the first internet browser that we had exposure to back in the early 90s. And Mark Andreessen says that blockchain is the most important piece of technology since the internet. And he should know because he helped build the internet. When they were building Netscape and the internet, the one piece that was missing was a way to send payments through the internet. And so what they had to do is rely on the credit card system. And there was a piece of software called SSL. It's a open source internet protocol that allowed secure transactions to go through the internet. And that's what they built the internet on. And a lot of people don't know that back in the early 90s, like 1992, it was actually against the law to do a commercial transaction on the internet. So before 1992, you couldn't use the internet for commercial transactions. And so Congress had to change the law, which allowed commercial transactions to happen through the internet, and then the SSL protocol was developed. Another person that identified the problem with the internet was Milton Friedman back in 1999. This is 10 years before Bitcoin was even developed. And he identified the problem that, through the internet, we can't send peer-to-peer money. A can't send money to B without, them using a central intermediary like a Visa, MasterCard, PayPal, Western Union, or someone to send money through the internet. And so that's what Bitcoin and blockchain protocols are. They're the final piece of the internet protocol puzzle. So we have HTTP, which is the hypertext transfer protocol, which is the internet. You have SMTP, which is email, simple mail transfer protocol. You have the DNS, which are websites, TCP, SSL. And Bitcoin is that final piece that we need so that we could send value through the internet, peer-to-peer, like we do with email today, without having a central third party clear that transaction for us. So it's just like handing someone cash through the internet, except we're using a piece of open source internet protocol software to do that. So what is the Bitcoin blockchain? Like I just said, it's open source internet protocol software. So it's free, it's open, anyone could develop on it. And what the Bitcoin software solves is what's called the double spend problem. And the double spend problem with digital assets is that if you have a digital asset like a song or a document, I could copy and paste that. And so, it makes it worthless. And you can't do that with money. If I send Dan $50 through the internet, I need to make sure it goes from my side of the ledger to Dan's side. And the only way that we can do that today is have a central third party clear that transaction for us. But with blockchain protocols, then we know that that money's been sent because it's an open ledger. It's viewable by anyone. So the trust is established by, we could all see the transaction. The ledger is viewable. We could see that the money moved from my side of the ledger to Dan's side of the ledger, and that's what creates the trust. So we don't have to put our trust in Bank of America or Wells Fargo or Western Union to decide, to determine whether or not they moved our money around. And like I said earlier, what this enables is peer-to-peer transfer of value through the internet. So why is this important? If you think about the church and the state 400 years ago, the church and the state were the same thing. If you lived in Spain, you were a Catholic. If you lived in England, you belonged to the Church of England. And when we separated church from state, that allowed all sorts of new advancements in science and technology and human, advancement. And the same thing's happening today. We're in the process of separating the money from the state. Today, money is controlled by the government. And we're at the beginning of this process to go back to how it used to be 10,000 years, where money was based on a hard asset like gold or silver. And this new money is called Bitcoin. And that's what this process that we're, like I said, we're just now beginning, it started 10 years ago. And as we separate money from the state, what that's going to do is it allow all sorts of new advancements in technology and financial technology and things we can't even imagine today. And I'm going to skip down to the last item there, the drives transaction fees to zero. We spend $2 trillion a year moving our money around the world and between each other. Those are wire fees, credit card fees, PayPal fees, bank transaction fees. We spend $2 trillion a year moving our money around. And with blockchain protocols, it's my thesis is that those fees are going to near zero. And we've seen that before because if you think of another blockchain protocol or another internet protocol called voice over IP, we saw that with long distance rates. Like raise your hand today if you still pay long distance phone bills. And the reason we don't pay long distance phone bills is because of a piece of open source internet software called voice over IP, VoIP. And so transaction fees for phone calls went to zero. And the same thing's going to happen with the transaction fees for money over the next 10 to 20 years. 20 years from now, our kids and grandkids, they won't pay transaction fees to move money around. We'll just do it peer-to-peer like we do with other types of like phone calls and other things. There we go. Okay. So let's talk about Warren Buffett for a minute. So for like a year and a half ago, Warren Buffett, someone asked him about Bitcoin. He called it rat poison. And I want to just go through Warren Buffett's thought process about Bitcoin. And what Mark Andreessen said after this. So, you can read what he said. The historical record of old white men crapping on new technology is about 100%. But I think Mark Andreessen's wrong about this. I think Warren Buffett actually does understand what Bitcoin is. He went through this process back in the early 90s. If you look at Berkshire Hathaway back in 1992, his top holdings were the Encyclopedia Britannica, Washington Post, a bunch of media and newspaper companies. 20% of his portfolio were in media, newspaper, and, like I said, the Encyclopedia Britannica. When the internet started, those companies almost became worthless overnight. Over the next 5 years, the newspapers, Encyclopedia Britannica, the value of those companies went down 90%. He's gone through this process one time before, 25 years ago. And he knows that Bitcoin is going to do the same thing to his financial stocks, Wells Fargo, Bank of America. He has 30% of his portfolio in financial stocks today. And he knows the transaction fees are going to zero over the next 10 to 20 years. And he owns so much of these bank stocks, he can't get out of them. And so that's, I think that's why he craps on Bitcoin and cryptocurrencies. It's because he knows he's going to go through the same pain that he went through 25 years ago. Sorry. So why invest in this asset class? One reason is that it increases the risk-adjusted returns in a portfolio. It's the new mega trend based on S-curve technology. We're going to cover all these in a minute. It increases the portfolio performance. The asset class is totally misunderstood. I've spent the last 6 weeks on the road. I've met with the UCLA endowment, Pepperdine's endowment, WashU, University of Illinois, and their Emergent Associates is a consulting firm. Their consulting firms are telling them that they need to have an allocation to crypto assets and digital currencies, and they don't know what to do. And when I meet with them, I go through the same deck with them and explain to them the value of owning these and what they're all about. So it's completely misunderstood, even by the largest institutions out there. So let's just go through some of the basics of Bitcoin. And the reason I'm going to talk about Bitcoin is because 70% of all the value of all the 3,000 cryptocurrencies out there are in Bitcoin. So Bitcoin's about, $220 billion market cap, and the total crypto market cap's about 300 billion. So Bitcoin's the largest one. It was the first one. It's been around for 10 years. It's the most trusted one. So we'll just focus on Bitcoin. But just remember, there's 3,000 other cryptocurrencies out there. So with Bitcoin, the basics are there's a maximum of 21 million Bitcoin that could ever be created. So that's in the software. It's hard-coded. It can never change. 21 million's the max. And it gets created at a rate of 12.5 Bitcoin every 10 minutes today. When Bitcoin first started back in 2009, the rate of creation was 50 Bitcoin every 10 minutes. And then what the software says is that every 210,000 blocks, and a block is about 10 minutes, so it equates to about 4 years. So about every 4 years, the amount of new Bitcoin that gets rewarded to the people processing the transactions through the Bitcoin machine gets cut in half. And so for the first 4 years, it was 50 Bitcoin every 10 minutes. And then in 2012, that got cut in half to 25 Bitcoin every 10 minutes. And then in 2016, that got cut in half to 12.5 Bitcoin every 10 minutes. And in May of 2020, the rate's going to get cut from 12.5 to 6.25. And in 2024, it'll get cut to 3 1/8. And it keeps getting cut in half and half and half. There's only 64 halvings of Bitcoin. So we've had 3 of them, or 2 of them. And the next one is in May of 2020. So we know what the supply is. The supply is fixed, it's determined, and it can't change. Okay, so what's the demand? Here's the demand. Since 2012, the number of Bitcoin wallets have doubled every year since 2012. Okay, I did this chart back in July. It's about 38 million. I checked it last night. There's 43 million. So we're up another 5 million wallets just in the last 3 months. And I haven't updated the slide. So since 2012, Bitcoin adoption rate, number of Bitcoin wallets has doubled every year. That's the exact same adoption path that email and internet were back in the early 90s. Okay, and what this tells me is that if this trend continues, that we have 40 million now, then 80, and then 160 and 320, and in about 7 years, there's going to be 3 to 5 billion people that will have a Bitcoin wallet address. Okay, we're on the same path that we were with internet and email. Okay, so we know the supply, and if you could foresee the demand, so what does that mean? If you have a fixed supply of something, you have increased demand, the only other variable is the price. So the price has to go up. And that's what we've seen over the past 10 years. Bitcoin's averaged 235% a year. Some years it's up 12,000%. Other years it's down 90%. But on average, it's averaged, about 235% a year. Okay? And what that tells me, if you just use a simple regression line and project that out, Bitcoin should be about 40-something thousand this year. What is it? 120 next year. 300 something in a few years. And the question I always get is, how high do you think it'll go? And no one knows. I can't tell you if it'll be $2,000 tomorrow or $1 million in 5 years. No one knows. But we know if demand's increasing and you have fixed supply, the price will trend higher. But there's no way to determine the day-to-day fluctuations in it. So Bitcoin is a network. It processes transactions, just like Visa, MasterCard, and PayPal. Visa and MasterCard started 50 or 60 years ago. PayPal started 20 years ago. And Bitcoin started 10 years ago. So let's just take a look at the size of these today. The Bitcoin network, these are 2018 numbers. So the Bitcoin network in 2018 processed about $3 trillion worth of value through it. Okay. The Visa network processed 11 trillion. MasterCard was 5.9 trillion. And PayPal was 578 billion. Okay. So in 2018, Bitcoin was 6 times larger than PayPal in the amount of money transferring through the network. Okay, and PayPal is twice as old as Bitcoin. MasterCard is at 5.9 billion, but if you look at the throughput today of Bitcoin, the average daily throughput through the Bitcoin network is $2 billion today. And so $2 billion times 365 days, Bitcoin's on a $7 billion run rate for 2019. Okay, so I think when we look at the end of 2019, I'm pretty confident I could say today that Bitcoin's gonna be larger than MasterCard at the end of this year. And probably in another year or maybe 2-3 years, it's gonna be bigger than Visa. So the other question I get is how do you value these things? With stocks, we use PE ratios and other metrics. With bonds, you use cash flow analysis and interest rates. But how do you value a blockchain? So like I said earlier, blockchains are networks. There's a way to value a network. It's called Metcalfe's law. And with Metcalfe's law, you square the number of users. And if you use a derivative off that where you square the number of users times the transactional value that's going through the network, that's what this regression model shows. And so between 2014 and 2017, there was a 94% correlation between this model and the price of Bitcoin. Okay, and in December 2017, it's separated. You can see that on the chart. And the reason it's separated is because what happened in December 2017, people had the ability to short Bitcoin with the futures market. And so what this tells me is someone's holding their thumb down on the price of Bitcoin today. Okay, eventually those shorts have to be closed out and the price will, I think, flow back up to that regression price of $38,000 today, which kind of goes with the trend value of 42,000 that we talked about earlier. S-curve analysis. So when I was at Cambridge, this is one of the things I learned is the amount of time it takes to go from 0% adoption of a new technology to 10% adoption is the same amount of time it takes to go from 10 to 90%. So I'm going to give an example of that. Back in the late 70s, Apple computers invented the Apple I. And then around 1980, they came out with the Apple II. And, and I look at 1980 as really the start of the, adoption of personal computers. So between 1980 and 1990, we went from 0% to 10% adoption. So when I graduated from University of Illinois in 1990, my parents gave me an IBM PS2 computer for graduation. I was one of the 10% of people in the United States who had a computer in 1990, a personal computer. Between 1990 and 2000, we went from 10% to 90%. So in 2000, 90% of households had a personal computer. Okay, you could use the same S-curve analysis for railroads in the 1800s, automobiles in the 1940s, fax machines, internet, mobile internet. It's the same curve. And the curve is the amount of time it takes to go from 0 to 10% is the same time it takes to go from 10 to 90%. And today we're at 11% adoption in Bitcoin. 11% of US households today own Bitcoin. And what that tells me is that in 10 more years, 90% of households will have I'm not going to say will own Bitcoin because it may not be Bitcoin. I'm going to say in 10 more years, 90% of households will have a digital wallet address, just like we have an email address today. And if we all have digital wallet addresses, that means we could send value to each other. And it may not be Bitcoin. It may be Libra or Ethereum or some other blockchain protocol that's out there. But I'm very confident that in 10 years, almost all of us will have some sort of digital wallet address. Okay, so like I said, 11% of US households own Bitcoin today, but how does that break down by generations? So I'm 51, so my generation, I think it's 5%. About 5% of people in my age group own Bitcoin. Okay, if you look at the millennials, 20% of millennials own Bitcoin today. Millennials grew up during the financial crisis. They saw what their parents went through. They don't trust the banks. They trust Bitcoin more than banks, and they rather invest in Bitcoin and internet protocols than invest in stocks, bonds, or real estate. Okay, and I've seen that through past generations too. My grandparents, their investment was cash in a tin can buried in the backyard. That's how they invested their money. My dad used to buy double E savings bonds. I grew up investing in stocks. My kids, they only invest in cryptocurrencies. You know, they're in college and that's all they want to invest in. They don't want to invest in gold or real estate or stocks. They want to invest in digital assets. Okay? So the younger generation, that's kind of how it's breaking down. When I was at UCLA last week, I was talking to the head of their venture capital group. She was in her mid-40s, and she said she didn't own any Bitcoin. She has a Coinbase account, but she never bought any. But she said all her analysts who are in their 20s and 30s, every one of them owned Bitcoin. And so that's just another example of, you know, how the younger generation is, you know, more adaptive to this technology. And the other thing about younger investments too, the younger generation, if you look at the millennials, there's 83 million millennials today. The baby boomers are 47 million strong. So the millennials are the largest generation in the United States. And if you want to look at what assets are going to do well over the next 10, 20, 30 years, you look at what they invest in today. Because as the millennials reach their peak earning years and their peak savings years, that's where, you know, they're going to be investing in digital assets. And that's what gives me the confidence that over the next 10, 20, 30 years, this is going to be a proven asset class to have exposure to. Let's get into some of the financial analysis of Bitcoin. The Federal Reserve Bank here in St. Louis is the hub of crypto research for the Federal Reserve. They came out with a white paper in January 2018, and the white paper in that it said, I highlighted there, Bitcoin will emerge as their own asset class and thus have the potential into developing into an interesting investment and diversification instrument. So the Federal Reserve here in St. Louis even recognizes the fact that Bitcoin can be used to diversify a portfolio. And the reason it can be used to diversify a portfolio is because it's a non-correlated asset class. And a non-correlated asset class, all that means is that the price of Bitcoin is not affected by the movement of other asset classes like stocks, bonds, gold, real estate. And you can see that there's a very little correlation between Bitcoin and the price of these other asset classes. So when you add a small amount of a non-correlated asset to a diversified portfolio, what does that do? And so this is 5 years of data from 2014 to 2019. During this time, Bitcoin had two 70% declines. So I didn't cherry pick the data to pick like the best performance of Bitcoin. This is like almost the worst period for Bitcoin because we've had two 70% declines in the past 5 years. So if we zoom in on this, if you take a portfolio that's 60% in stocks, 40% in bonds, that portfolio over the past 5 years averaged about 6.3%. And the volatility was about 7.6. The Sharpe ratio is a way to measure risk-adjusted returns was 64%. And the maximum downside that this portfolio had was 11.7%. So if we just take 2% of that portfolio and add it to Bitcoin, so we have 58% in stocks, 40% in bonds, 2% in Bitcoin. The returns go from 6.3% to 8.4%. So returns go up 35%. But the volatility and the maximum downside, there's no measurable difference. So the Sharpe ratio goes up to 90%. The risk-adjusted returns go up to 90%. So what this means is that asset managers, fiduciaries, endowments, as they learn this, as they understand that adding a very small amount of crypto assets to a portfolio increases your return and doesn't increase the risk, they're under a fiduciary responsibility to add these assets to their portfolio. And that's what's been done at Harvard, Yale, Princeton, MIT, Washington University Endowment. they all have exposure to crypto assets today. And as Wall Street finally comes on board, there's going to be even more demand for crypto assets. And so I think it's still really early in the game to beat Wall Street and beat the other institutional investors out there. And the way this kind of works is that the early bird catches the worm. Another reason to invest in crypto assets is that it's a way to exit the financial system. So over the past 50 years, when we went off the gold standard in 1971, our money's been based on trust. We trust the government. We have full faith and trust in the dollar, right? Well, the government has an unlimited ability to print dollars. And the more they print, the less a dollar's worth. And we've seen that, with inflation over the past 20, 30, 40 years. So what blockchain and Bitcoin does, it gives you the ability to have money, and it's money based on software instead of money based on trust. And that's what people are starting to realize, is that I may not trust the government 100%, but I'll trust them 98%, and I'll have 2% over here in crypto just in case. And that's what's happening. And back in 2009, when we went through the financial crisis, the central banks decided that the cure for too much debt was more debt. And that's what's happened over the last 10 years. Debt to GDP has gone up, and total debt has gone up around the world. Okay? And I think eventually that blows up. So here's another interesting stat. If you go outside the US and you go to Germany, Italy, Japan, Spain, 90% of the government debt that's issued outside the US has a negative yield. That's $17 trillion worth of debt. And what that means is that if I live in Germany and I buy a German 10-year bond, and I put $10,000 in a German 10-year bond, in 10 years, I get $9,500 back. They give me less back than I put in. That's what negative yields mean. Okay? And that doesn't work. That math does not work. If you're an actuary, if you run an insurance company, that you're required to invest in bonds, how are you supposed to pay your life insurance claims in 50 years or 20 years when you have negative yields on your bonds? How are you supposed to pay your retirees when they give you less money back than you put in? Okay, so that game doesn't work. It eventually comes to an end. And I think when it comes to an end, people are going to realize that you should own crypto assets that have a finite supply rather than an unlimited supply of fiat money or government money. Another way of looking at this is that we have 5,000 years of history of interest rates. So we can go back to 3,000 years BC, and it's been 2,000 years since. We have 5,000 years of history. During that 5,000 years, interest rates have tended to be between 2 and 8%. Okay? Now they're at zero in the United States, near zero in the United States. They're negative outside the United States. Okay? And if you know basic finance, what that means is that when yields are low, bond prices are high. Okay, so another way of looking at this is that we're at a 5,000-year high in bond prices.
Yeah.
Right? I mean that's right. If yields are at 5,000-year low, that means prices are at a 5,000-year high. Okay. So when people say, Bitcoin's a bubble, stock market's a bubble, the real bubble is the bond market. You're overpaying for bonds today if you're invested in bonds. So when is the tipping point? When do we convert from cryptocurrency to, or from fiat money to cryptocurrency? No one knows, right? But I think we're on that path. So for 10,000 years, we used gold and silver and hard money as our assets. And then the Chinese invented paper money that's set on top of the gold market. So gold was the underlying asset. You had paper money that you could exchange into gold whenever you wanted. And it was like that in the United States until 1971, when Nixon closed the gold window at the Fed. And so since 1971, our money's been based on trust in the government. Okay? And I think that 100 years from now, or 200 or 300 years from now, I think our ancestors are going to look back on us and kind of laugh at us. For 10,000 years, humans used gold and silver, and your hard money. And for like this 50 to 70 year period, they put trust in their government, but now we're back to hard money. And I think, we're in that process of converting back from fiat money into something more tangible. And so, like I said before, money, the government money is based on trust. Only 17% of Americans trust the government most of the time. It's at an all-time low. Just 20 years ago, it was in the 50 to 60% area. So, and I think as this, continues to occur, that more and more people will shift a little bit of their money out of government money over into money based on software. So who's interested in all this stuff? Cambridge & Associates recommends an allocation to blockchain. They're the largest institutional consultant in the United States. They have several $1 trillion under management. The CFA exam, Certified Financial Analyst exam, hardest exam in the United States to pass. They test on crypto assets, and they're level 2 and 3 exams today. Like I said earlier, Yale, Harvard, Princeton, Stanford, MIT, WashU, they've all made allocations to crypto assets the last couple of years. And even the Federal Reserve Bank says that Bitcoin's a good tool to diversify a portfolio. So why should you pay attention to this now rather than wait 10 years when it's more it's been mass adopted? The Intercontinental Exchange, which is ICE, they own the New York Stock Exchange and major exchanges around the world. They started a new company called Bakkt a couple years ago. Bakkt just recently launched, I think about a month ago. And so what Bakkt does is they allow institutional investors to buy Bitcoin through a futures market and have it physically delivered to the Bank of New York Mellon. So this is the first true institutional infrastructure that we have on Wall Street that started about a month ago that allows big institutions to buy into the asset class. Fidelity's Bitcoin desk opened earlier this year. For 5 years, Abby Johnson, who's the president of Fidelity, she's been testing Bitcoin. They've been mining Bitcoin at Fidelity. They've been kind of trying to figure out what this is all about. And they came up with the same conclusion that we were talking about today, that Bitcoin's the winner, they only offer Bitcoin, and that over the next 10 or 20 years, that Bitcoin's going to be a good investment. So they opened up a crypto exchange at Fidelity that allows their portfolio managers to buy Bitcoin. So over the last few months, Fidelity Mutual Funds has been buying Bitcoin for their own mutual funds. And then recently they opened it up to their institutional clients. And just last week they opened it up to retail clients. So now if you have a Fidelity account, you'll soon be able to buy Bitcoin through Fidelity and have it custodied in your Fidelity account. And Fidelity custodies $7.2 trillion worth of assets. The Summer Olympics are going to be in Tokyo this year. Japan made Bitcoin an authorized payment method back in 2017. What that means is that if you're in Japan, if you're going over there for the Olympics, you don't need to convert your money into yen. You can just go over there with Bitcoin on your phone, because every point of sale machine in Japan accepts Bitcoin today. And then the Bitcoin halving. Like we talked about, every 4 years, not every 4 years, the supply of Bitcoin, new issuance of Bitcoin gets cut in half. Okay? When this happened in 2012, Bitcoin was around $12. When it happened in 2016, it was $650. And Bitcoin has these cycles that it goes through. Okay? And the cycle is that after the halving, Bitcoin has a big run up. So the best time to be invested in Bitcoin is May of 2020 to May 2021. And that's coming up. And what happens a year before the halving is people start to front run that. Okay, and that's what happened this year. Bitcoin was around $3,500 in May of 2019. It ran up to 14,000. It's trading around 8,000 now. And so we're in this accumulation phase of Bitcoin today. And now is the time to be making an allocation into the space. Because after the next halving in May of 2020, we're having another run up. And that run will probably take us up close to $100,000 per Bitcoin on the next run. What we do at Off the Chain, we're a Reg D offering, so we can't talk about performance or anything like that. in this setting because we have to verify everyone's an accredited investor, and we haven't done that. But the basic thesis behind our portfolio is that we're looking for mispriced digital assets. We're looking to buy Bitcoin at below the spot price. So we do that through bankruptcy auctions or bankruptcy proceedings, government auctions, and other ways that we've identified. And then we make investments in post-A-round blockchain companies. We provide a liquidity pool for employees at blockchain companies that have been around for 3 to 5 years that need liquidity because they're getting married or getting divorced or having a baby or need to buy a new house or need to pay their taxes. And we're generally able to get those equity investments between a 20 and 30% discount to the last round. So we're value investors. And the big ask today is don't take my word for this. You guys go out and do your own research. You know, Google Bitcoin, start learning about it like I did five years ago, and discover for yourself what this is all about, and decide for yourself whether or not this is an asset class that you should be exposed to. We have this deck. If you want us to email it to you, just email lp@offthechain.capital. We'll send you this deck. We also identified several videos that we've used with other tutorials that have they'll give you a good reference on what Bitcoin's all about. So there's about 3 hours worth of videos. One of them is, there's a Stanford professor that teaches the economics of Bitcoin, and we have her video from 2015. She has a short 45-minute lecture, and she explains exactly how Bitcoin and all the cryptocurrencies work. So it's a very useful video. And if you want copies of those, like I said, just email me and we'll send you those links. And I know we have 10 minutes for Q&A, and then we'll stop and let whoever wants to leave. And like I said, Bill and I stick around and talk about this more. So. Okay.
You said Fidelity is in the retail market with Bitcoin now. Does that mean they can serve kind of like a billfold then?
So they're using it for investment purposes only. So you can't buy Bitcoin and use it through Fidelity. You can buy Bitcoin and hold it in your Fidelity account. They're providing custodial services for Bitcoin, but they're not providing exchange services. So if I have a Fidelity account, if I'm an institution, I want to buy $10 million worth of Bitcoin, I'll put the order in. Fidelity will take that order and go to Coinbase, Genesis, Gemini, the major exchanges in the US, get the best price, and then execute that trade, and then Fidelity will custody that Bitcoin for their clients.
Brian, what's the effect? I've read several things about quantum computing and what that effect
That's
may
one of my concerns too. So I'm not smart enough to know that, so I asked someone who is smart enough. So Jeff Garzik was one of the original Bitcoin developers. He runs a company called Block. I mentored Block through our FinTech Accelerator at 630 when they came through. And I talked to Jeff about this like 2 weeks ago. And because Google had an announcement that they came out with a quantum computer that could break cryptocurrencies. And so from what Jeff tells me is that, I don't want to get too technical, but the hashing rate, the cryptography that Bitcoin uses, it's called a SHA-256 hash rate. And he said if a quantum computer ever gets close to being able to break the cryptography on that, they'll just increase it to 512 or 1024. And eventually you increase the cryptography so much that there's not enough electrons in the universe to break it. So you can always stay a step ahead of quantum computers through increasing the hash rate.
Yeah, I read where at the rate that Bitcoin and blockchain is expanding, that it can overtake the computing system that we have.
It could consume all the electricity in the world.
That's right.
Yeah, if you ever need to increase the cryptography that high.
So as to scalability, the security, as I understand it, of blockchain is because there are many different nodes everywhere. Everyone, in effect, has to approve the transaction.
Come to a consensus, yes.
So as this expands exponentially, doesn't the size of the block grow and the length of the transaction time and approval grow?
That's what happened 2 years ago, right? So the block
So much
size,
that it chokes the system and makes it illiquid.
so it doesn't make it a liquid, but it slows down the transaction. So that's why Bitcoin today isn't used for like cash. You know, the original thought behind Bitcoin was that it would be a cash system, and that use case failed. The use case for Bitcoin today is a digital store of value like gold. Okay, and so to answer your question, the block size is fixed at 1 megabyte per block. And if you're old like me, remember we used to have the floppy disk, the 256 floppy disk? So it's two of those. It's two floppy disks. That's the amount of data that's in a block. It's not a lot of data, okay? And that's what happened a year and a half ago, was that there were so many transactions trying to go through the blockchain that the system got clogged. And what happened was that the cost to clear a transaction skyrocketed from a few cents to up to like $50 or $60. Because the miners were charging extra fees to clear the transaction in 10 minutes. If you weren't in a rush to clear your transaction, then eventually it got cleared like in an hour or two at a few pennies. So if you want to be in the next block, you have to pay up. If you don't care what block you're in, then it doesn't matter. So
That's an okay thing for
That-
a
that's
monetary
fine.
system to have
Yeah, because-
slowness.
because if you think about it, so just to talk about the history of money a little bit. So gold was the primary layer that we had. The Chinese developed paper money on top of that. And then the Medici family back, 400 years ago invented the credit system on top of that. Okay, so Bitcoin's gonna be the same. Crypto's gonna go through the same transition over the next 100 years. Bitcoin's gonna be the gold. Okay, there's gonna be another layer on top of that, which will be the transaction layer. Okay, and that might be the Lightning Network or Libra or something being built today. We don't have that transaction layer yet. And then there's gonna be a credit layer built on top of that. And there are several blockchains that are being built today to provide that credit layer. Okay, and we're just not there yet. Bitcoin's been around 10 years. It's going to take 20 more years to build these other layers on top of that. But eventually there'll be a transaction layer and a credit layer on top of the Bitcoin layer, just like we have cash and credit today.
So is it an asset class or is it a currency?
It's not a currency. So the SEC calls it proper, or the IRS calls it property. The Commodities Board calls it a commodity. The SEC, they say it's not a security. They don't say what it is, but they say it's not a security. So it's kind of a blend of a bunch of different things. And that's why I go back to the first slide, think different. This isn't something we've seen before. It's not Bitcoin could be a currency if the block size was larger and you didn't have to pay a tax every time you used it because of capital gains, because the IRS taxes every transaction if it has a gain on it. So you can't really use that as a currency. Over in Europe, though, it is a currency. So there are no capital gains on Bitcoin in Europe or cryptocurrencies in Europe. So in Europe, people do use Bitcoin as a currency. It's just like a euro or a dollar over there. So, but in the United States, it's property. It's taxed as property. The SEC, it says it's not a security. It's more like gold in the United States than anything.
Brian, one other question. In terms of what the governments of the world, they want to control their money. Obviously, Bitcoin allows you to go around the government and the transfer system. This has got to come to a head at some point where the governments are going to allow it or they're not.
Yeah, the only way to shut down Bitcoin is to shut down the internet. So there's 9,400 nodes out there that are distributed throughout the world. Each node processes Bitcoin transactions. So to shut down Bitcoin, you have to shut down all 9,400 nodes. But if you shut those down, you're going to have, anyone with a laptop, pop up a node because there's an economic incentive to mine Bitcoin. there's $15 million a day in rewards that are paid out to miners. So if no one's mining it, there's a free $15 million that anyone could go and mine Bitcoin and clear the transactions and get 15 million a day. So there's always that economic incentive out there. So eventually, back in 2014, I was worried about that. So Congress actually held hearings in 2014 whether or not to outlaw Bitcoin, like they used to outlaw financial transactions on the internet, and they decided not to do that. So I think it's too late to stop it, and if you could stop it, it's too late to do that. So it's already out there. It's kind of like a thought. Once you know about it, someone can't take that away from you. So, and that's what software is.
Question, Brian. The United States government, is there a good chance that the United States government holds an awful lot of Bitcoin?
The United
in
States
their
government is the
possession?
largest holder of Bitcoin. No, we know the FBI owns 1.5% of the world's Bitcoin today. When they seize it from criminals, they keep it. The U.S. Marshals, they auction it off.
That would make that be a reason for that.
Yeah, I mean, and that's just the public. We don't know how much the Federal Reserve. I know the guy who wrote the white paper for the Federal Reserve in St. Louis. He's owned Bitcoin since 2012. So, and I asked him, does the Federal Reserve own Bitcoin? And he wouldn't answer that. So I would assume that Bitcoin's owned. We know 1.5% of the world's Bitcoin is owned by the FBI. That's public knowledge. So.
I can't believe that Visa and MasterCard are just sitting by idly letting $2 trillion, whatever their fees are, go away. What are they doing in this space?
So they're competing. So they're coming out with their own blockchain. They were part of the Libra Association, and then they backed out because Congress threatened to, jump all over their case. But Libra is it was sponsored by Facebook. So there's someone you can go after, right? You go after Facebook or Visa or MasterCard. Bitcoin, there's no CEO of Bitcoin. There's no Bitcoin company. You can't go after someone. It's just software. So there's no way to shut down Bitcoin. So eventually, Visa and MasterCard will figure out what their business plan is. But, if you think about Visa and MasterCard, most of their fees that they charge go to pay for fraud. To cover people with fraudulent transactions. Okay, Bitcoin, you have no fraud because Bitcoin's a one-way transaction. When I send you Bitcoin, I can't go in and retrieve that back. And the only way I could send you Bitcoin is if, I know my private key. I know my password, basically. Okay, so with Bitcoin, if someone sends you Bitcoin, that's a true transaction. There's no fraud in that. Because they have control over your private keys. So it's 12:30. We'll go ahead and adjourn, and then whoever wants to stick around will be here to answer more questions.